Okay, welcome to chapter 23, which is talking about partnerships. Up until this point, we've only ever had sole proprietorships and corporations. And the last bit of our book is here to talk about partnerships because there are situations where a business might need skills and capital of more than one person, but that they don't want to wish to be organized as a corporation. And on the next few slides, there'll be one that talks about the pros and cons of all three of these types of ownership. But in that situation, you could have a partnership, which is where a business where two or more people combine their assets and skills. So a partnership technically could have three or four or five people. It's just that they don't organize as a corporation. Partner doesn't necessarily just mean two. I want you to remember that. And that each member of a partnership is called a partner. So like I said, you could have just two, but you could also have three, four, or five. Now, as in other forms of ownership, in a partnership, reports and financial records of the business are still going to be kept separate from the personal records, which is just another application of the accounting concept of business entity. You want to make sure that your things are kept separate. So this is a slide that I was talking about. The three different forms of ownership are sole proprietorship, partnership, and corporation. With the sole proprietorship, one of the advantages is it's very easy to form. As the sole proprietor, meaning only one person, you retain all of the profits. You also have total control, and it's a very simple tax structure. On the disadvantages side is that you do have unlimited liability, which means that if the business fails, you fail. You have less capital available because you're only one person. You also might have limited vision and skills because you are the only person. You don't necessarily have other outside people. And it also um, terminates with the life of the owner. So when the owner dies, your sole proprietorship dies. Now, with a partnership, it's still easy to form. You do get more capital because you have more than one person. You also get to share the work, and you have a partner that can bring in different skills and areas of expertise, and it still has a simple tax structure. Um, a disadvantage is that it still is unlimited liability. It's just that you split that liability between the partners. You are liable for your partner's actions, though, so it's important that when you choose to do a partnership that you have people that you can trust. You still have to share profits. It's also harder to dissolve because you have one, two, maybe three other people you're working with, but it still also terminates with the life of one partner. So if one partner dies and the other one still lives, the partnership still dissolves. Now, with a corporation, an advantage is that there's limited liability. So when you form as a corporation, you as an owner are protected. Your personal assets are not liable to the health of the business. It's also easy to transfer ownership from one person to another, hence when we've talked about stock. And it has an unlimited life. It does not terminate with the death of one of the investors. The disadvantage is that it is harder and more expensive to form. It's not easy. You have to register your corporation in a state where you're going to be headquartered. You do have less control because you have many more investors than you would with a sole proprietorship or partnership. And it is doubly taxed. So you're taxed on your net income that you receive, and you're also taxed on the dividends that get paid out to stockholders. And the government has more regulations with the corporation as well, so they kind of have your fingers in your business. So those are just some advantages and disadvantages. You're probably going to want to make sure that you know those for the test in a few days. Now, with a partnership agreement, or with a partnership, typically you're going to have a partnership agreement because you are not the only person, you're working with more than one. So usually there's a written agreement that sets forth conditions under which a partnership is going to agree to operate. So legally, a partnership agreement can be either written or oral. However, it's usually encouraged that you have a written agreement so that there aren't going to be any misunderstandings that happen. If it's in writing and you both have signed it, then it's a legally binding document and you both would be aware of what you're getting yourselves into. Now, partnership agreements usually include all of the following. Obviously, the name of the business and the partners, what sort of investments each partner brought to the business, whether that's cash, supplies, merchandise, equipment, plant assets, things like that. It also specifies the duties and responsibilities. Maybe one partner is more skilled in advertising, so they take care of that, and maybe one partner is more skilled in the financials, so it divides duties and responsibilities. It also specifies how profits and losses are going to be divided. So how much does each partner receive of the profits? How much does each have to kick in if there is a month where you have a loss? It also talks about what happens if a partner dies. It also talks about what's going to happen should the partnership decide to be dissolved and the duration of the agreement, because you could have a partnership agreement for a year or 2 years and then you may need to come back and revisit and make a new written partnership agreement. Now, when it comes to initial investment by owners, our new business that we're going to be working with is called Must Have Gadgets. It's our example business, and it has two partners, Sarah Hatcher and Parker O'Reilly. So, according to their partnership agreement, Sarah Hatcher contributed cash and Parker O'Reilly contributed cash and office equipment. So, when you do this, even though you have two owners, you still do separate journal entries for each partner's initial investment. So what that looks like is Sarah Hatcher contributed $20,000 in cash. So cash is going to go up by $20,000 and her capital account goes up by $20,000. So in our cash receipts journal, we just have Sarah Hatcher capital for a credit of $20,000 and a debit of cash for the owner number one. Then our second owner contributed both $17,000 in cash and office equipment valued at $3,000. So that goes again in our cash receipts journal. Office equipment is being debited for $3,000. Cash is being debited for $17,000, and O'Reilly capital is going up by $20,000. So technically, they both gave the same amounts. It's just that one happened to be all cash and one is cash and office equipment. So when we do this, it looks like this. Our office equipment goes up by $3,000 with a debit. Parker O'Reilly's capital goes up by $20,000, and then a cash debit of $17,000. So they both technically gave $20,000 worth of stuff to their partnership. It's just that it gets distributed a little bit differently. So you just want to make sure that initial investments, they're done separately for each partner. Now, during a fiscal period, partners can take assets out of the partnership in anticipation of the net income for that period. Now, just as we did with a proprietorship, assets that are taken out of a business for the personal use of the owner, we call them withdrawals. So there are technically three types of assets that can be taken out of a merchandising business, and those are cash, supplies, and merchandise. Now, the partnership agreement may limit the amount of assets that can be withdrawn at a time, but again, you would have to check your partnership agreement. There is actually one on page 723 of your book if you want to look at a sample one. They don't have one in the PowerPoint, but one does exist there for you. So we know that income increases our capital account. If you have a net income, it's going to raise your capital account with a credit. We have two separate drawing accounts for our partners, just like we had two separate accounts for their capital. So Sarah Hatcher drawing and Parker O'Reilly drawing. Our drawing accounts have normal debit balances because technically they reduce owner's capital, so they have to be opposite of the capital account's normal balance, which is a credit. So our first partner withdrew cash. Parker O'Reilly took $750 in cash out for check number 2, so that's going to go in our cash payments journal. Parker O'Reilly is our account title, goes up with a debit of $750, and our cash goes down with a credit of $750. So it's essentially the same as we did with our personal or sole proprietorships, excuse me. Now, even though it's uncommon, a partner can actually withdraw supplies or merchandise for personal use. So our transaction actually says that our other partner withdrew supplies. And so that's actually going to appear in our general journal since it doesn't affect cash at all. So what happens here is that Sarah Hatcher took supplies for personal use. It's a memorandum. So her drawing account goes up with a debit of $450 and supplies goes down with a credit of $450. And again, that has to go in our general journal because supplies is not cash. So since cash is not affected, it can't go in the cash payments journal. So it goes in the general journal instead. So that brings us to the end of 23.1. So you have your on your own and your application to do. And then there also are a few short terms and questions to do for 23.1. They're on page 727 of your book and also in your Google Classroom.